So in today's Ride with an Accountant, I wanted to talk about real estate investments and real estate investing. So I have a number of clients who, once they obtain some wealth, they turn around and put that wealth into real estate investments, which is a good thing to do. It can be relatively passive, I won't say 100%, but it could be a good way to park some money. What I wanted to hone in specifically, renting out property, mainly residential. You have the option now of doing either a long-term rental or a short-term rental. Short-term rental being your Airbnbs, your Verbos. That's, I guess, the rage nowadays. And now I've actually been seeing news that some of them just haven't been forming as well as they might have formed, say, during the pandemic. But that would be your definition of your short-term versus your long-term, where you have your traditional renters in there, 12 months, 6 months. But for the purpose of the tax code, anything shorter than a 30-day is considered a short term. But what I wanted to hone on, there is a difference in tax treatment depending upon which way that you go. Let's focus on the losses. And losses, a lot of times with rental properties, are generated by depreciation, which I think why rentals could be great, because it allows you to essentially get tax-free cash flow, where you could be cash flowing on the property, but you get that extra deduction of depreciation, which you have an opportunity to deduct a portion of the cost of the property over a long period of time. So many clients that I have, they're cash flow positive, but they're able to show losses or zero taxable income on it. Good way to shelter some income. Now, a problem that a lot of my clients run into is that if they have losses, because of the nature of the loss being passive, they're not able to deduct that against other income. When it's passive income, it has to offset other passive income. So many folks, if you say have rental properties, you might still have a job, which is active income, or business that you operate, which is active income. Unfortunately, if you make over, at least on the federal side, 150K, any losses that you incur from your real estate activities, again, long term, you're not able to offset that. Now, in the sense of any other business that you would operate, if you incurred a loss, you could offset against your other active income. But again, long-term rentals are considered passive, not active. So if you make over 150K, you're not able to take those losses. If you make less than 150K in other active income, then you can deduct those losses. There is a limit on those losses, but nonetheless you can, again, and that's if you have a long-term rental. Now, you take that same property and you use it as a short-term. Short-term is treated a bit differently, because short-term rental, in the eyes of the tax code, that is considered an active business. And don't get it twisted, it is an active business if you're doing short-term rentals, because you're no longer in property rentals, you're in the hospitality business. If you have your property and do the whole Airbnb, Verbo thing, you're doing hospitality. That's an active business. That's not a passive business. So obviously there's a lot more involved with that, with the operations, between the turnaround, and you have to clean up between folks, you got to do the bookings. So there's a bit more involved with it, which would justify it being an active operation. Now, with that said, because the short-term rental is considered an active business, any losses that you incur, you can then offset that against your other income. So that could be a good strategy to use to offset other income. Now, I will say this, I am not a believer in the train of thought of spending money just to save taxes. Yeah, I think that's actually kind of dumb, but it's one of those things where, because it's not a one-for-one deduction. If you spend $100 on something to hope to save taxes, you're not saving $100 in taxes. You're saving whatever your tax bracket is. So if you're in the 35% tax bracket, spending $100 to save 35 doesn't really make sense. I wouldn't go out and operate at a loss, a short-term rental, just to be doing it. Maybe there's a situation where it may work, where let's say it's a vacation home for you, but you're only there a couple weeks out of the year. You decide to rent it out the rest of the time. So that may work. If you operate at a loss, obviously you have it for personal use, you get that benefit, It'll offset some of the cost of you holding that property, but at the same time, any losses that you may incur from that property, you can now offset that against your active income. So just a quick tip in knowing how you may be able to utilize the short-term rentals when you're deciding whether to do a long-term rental or a short-term rental, if that is an option. Because nowadays we're seeing more and more localities actually crack down on the short-term rental. So if you decide to go that route, obviously make sure it's available and legal in your locale. All right, that's all for now. See you on the next one.